Welcome to another episode of This Week in Pre-IPO. I'm here with our three experts in the space. We've got Clint Sorensen from Wealth Shield. We've got Aaron Dillon, who runs AG Dillon and Company. And we've got Nick Fusco from 8View. We've got a slew of topics that we're going to be talking about today. It was a busy week last week in pre-IPO. A lot of big names, a lot of big movements, and the public markets were certainly a scorcher last week, especially as earnings season has been heating up. The first company I would like to talk about today is Epic Games. For those of you who don't know, Epic Games is one of the large gaming companies. They've been around since 1991. They've got about 100 million users, and they produce the very popular game Fortnite. They're also the technology team behind Unreal Engine, which is one of the major software layers for behind a lot of the different gaming companies and graphics companies in Hollywood. They recently announced a new funding round of $1.5 billion from Disney. This funding round is actually 29% less than the last round that Epic Games did, which was a $31.5 billion valuation, and they raised $2 billion from Sony and Lego. As a part of that last round, Epic Games partnered with Lego to launch Lego Fortnite, which has been a massive success for the company. And it looks like this new funding round of $1.5 billion, Disney's trying to sort of recreate the same engine here and the same success. I'll talk a little bit about the markets themselves. The secondary markets have been pricing Epic around $10 billion. So this new funding round is a substantial increase from what we've been seeing in the private markets trading hands. And the revenue right now looks like it's 5x revenue of the multiple from the revenue estimates. So diving in here, guys, let's talk about this for a second. Epic is a massive brand. As we know, Activision, it recently just got acquired by Microsoft. That was a little over $60 billion. Clint, I'm going to kick it to you. So what do you think about this deal? What are you seeing in the space? How do you feel this deal was priced? And how do you feel like the momentum behind Epic is looking today?
When you're seeing big brands get behind Epic, I think they're all in the same recognition that we have, right? We've been talking about this on the podcast, and I think the metaverse is here to stay. I think Epic has the most mature metaverse. And I think you're going to continue to see big brands jump in. It's just another outlet, right, for established media, and you might as well jump in. As far as pricing, I still think it's cheap. I think they're still down from their last round, like you mentioned. If you look at their long-term trajectory, and if you look at the fact that there's going to continue to be entrants and big opportunities in this space, and it's only going to grow from here, in my opinion. So I think it's cheap. I think it's a lot of
the secondary is cheap.
Well, 5 times revenue, right? I think you should see this thing trading at 10 times revenue. So that's what I see from a valuation perspective in terms of its growth trajectory. Even though it's been around for a while, I just think the metaverse is in its infancy.
It is, but let's talk about the exit strategy here for a second. The company's been around since 1991. Nick, if you're trying to value the company, at a larger multiple, you got to also sort of assume like what's the trajectory there. And they also have an overhang of this Apple lawsuit. I don't know if you guys are aware, but Fortnite hasn't been in the Apple Store for like 2 years. So they're missing out a huge number of customers, which is certainly hurting their revenue today. Aaron, I'll kick it to you. Like, what are you thinking here as a buyer or seller at this price and or, what you're seeing in the secondary market?
Yeah, well, Epic Games products are rock solid, right? So I would put the challenge that they have with Apple around, distribution of that, but Fortnite's like a foundational product. I have 3 young kids. They all play Fortnite. It's like a religion for them, right? So, there's that. Unreal Engine, to your point, is totally dominant in the metaverse space. And I think that's going to become even more important now that we have like Apple Vision Pro and devices like this that are hitting the marketplace. So, yeah, I mean, I think the prospects for the company to drive customer growth as well as revenue going forward is big. To Clint's point, with these big, huge brands surrounding it now, I think you're going to start to see like Star Wars Fortnite. You'll see Marvel Fortnite. I mean, that's going to be huge, right? So I think big revenue opportunities ahead for these folks. And then to Clint's point too, I mean, I got to tell you, 5x revenue multiple is too low for a company like this. Their revenue has come down a little bit year over year, but if they can start getting this thing going again, I think it could be a very attractive business opportunity.
Hey, Nick, what are we seeing on the data side? What are we seeing in the trading markets, and how are you looking at the price compared to value today?
I mean, the fact that there's 100% delta between where secondary is and where this deal is getting struck, that's pretty wild, right? So maybe there's a deal. I never like to use the term arbitrage to pick it up in the secondary market because there's no liquidity. You're not getting in and out of that without doing the whole thing again. And as Clint and Aaron know, it takes a few weeks to get these deals done, right? But it could look really cheap as long as that core asset of Fortnite isn't going to go away. So you're not going to have the kids doing a different dance in 2024, when you're walking down the street and you see them throwing their arms around their hips, and you know what I'm talking about. But I think the Disney piece is a game changer. The fact that you had Lego and Sony pile in at 50% above that makes it a kind of strange arrangement, though. Disney is a bigger brand than Sony and Lego probably combined. So yeah, they probably deserve that, and they can bring in all the other franchises behind it. But why is there such a big divide between secondary, where this deal got done, where the last deal got done? That's kind of mind blowing to me. Like, where do we mark this thing? Is it marked a mystery, or are we happy with the secondary levels at half, or where's it going to go?
But Nick, you gotta think that the secondary is going to come up to this new round, right? At least reset. It could come back down again, but if I'm looking to buy now, I would think that's the price.
So I look at this very much as a strategic round and not just a pure VC play coming in. So usually we see secondaries coming in about 8% below, at least for the last year or two, on where those rounds occur. We are so far beyond that. So I think you're right. The secondary has to come up closer, but I don't think the secondary is going to match or even come within a 10% buffer of where the Disney deal is getting done. At least not in the next month, right? And a lot of these things are meant to reprice fast, but I don't think this is going to be the case here.
Clint, Aaron, it sounds like you're both buyers at 10 billion. You're definitely buyers. Are you guys buyers at the price that Disney paid?
Yeah, I am. To Nick's point, he said that it's kind of mind blowing. You almost want to question how long this Disney deal's been being negotiated, right? And whether there was some knowledge that they were going to come to the table, right? And then it would make sense that maybe, hey, okay, well, I understand why Lego and Sony are jumping in. This is going to be a big wave. And so they're just like, hey, let's just get in now. And then Disney is still finishing their negotiation, and they come in at a lower valuation. We just don't know the structure. So I still think it's cheap. I'm a big bull on the metaverse just long term. I mean, the fact that they're throwing concerts in here, the brand power that these big brands are going to have in the metaverse, the new entrants from a demographic perspective into the brands, or continued support and continued loyalty from customers with these big brands. I think it's just going to continue to play out. I'm also biased because I live right down the street from them, so it's a little bias, a little local biase here. But
neighborhood.
But let me ask you, if you're buying Epic today at 21 billion, and this company's been around since 1991, it's over 30 years old. Like, is this a forever hold? Like, is there liquidity in the horizon? How long do you think you're going to hold that for?
Yeah, because I think at the end of the day, when you think about their history, it hasn't been Fortnite and Metaverse. That's really what put them on the map, right? They were doing other traditional gaming businesses prior to that. With the advent and the acceleration of technology, with the Metaverse being such, in my opinion, a big piece of the future of that, especially the way we experience, whether it be work or gaming or play or social, I think now it's probably a 10-year hold is the way I would look at it. I look at everything that way, but I absolutely think there's going to be plenty of exit liquidity for them on a traditional route, right? I don't know necessarily if they sell to someone, although they'd probably be pretty attractive to folks, but maybe it's an IPO. And I think that would probably be the play that I would see it progressing down. It's a platform. It's a metaverse platform play.
Yep.
And Aaron, just kicking it to you just on the diligence side and looking at this deal. This company's been around for a long time. They've raised strategic rounds. They've raised traditional venture rounds. They've been in the news. They've been controversial. When you're diligencing this sort of opportunity, even at 10 billion or 11 billion or even at 21 billion where it just was marked, like, are there any red flags that you're looking at there that you're like, these are things that I need to be aware of or conscious of before deploying capital into this company?
Yeah, I mean, the thing with Apple is not great, right? I mean, like, anytime you make an investment, you got these huge, landmine type things that you got to look at. I mean, Apple's a huge distribution channel. That's something to probably consider. But, it's one of many for Epic Games. I mean, I agree with Clint. I think it's a 10-year hold. I also think that Unreal Engine, I think this Apple Vision Pro thing to me was like a catalyst moment. I think the metaverse, augmented reality, all that stuff plays into what's happening there with Unreal Engine and just their model. It's really a developer kind of creator focused type model in Unreal Engine. There's no upfront cost or hard cost to use it. It's all percentage of revenue earned. So what's a really interesting twist, like Apple charges a percentage of revenue earned on its platform, and Epic Games does the same thing with Unreal Engine, right? To a certain degree, right? Which is very interesting. I'm sure they would say it's different and has a different nuance to it, but it's pretty similar. I think you got to watch out for big landmines with companies like this. On the liquidity stuff, I don't know. I mean, I'm less concerned about that, especially as I've been living in the secondary markets. You can buy in the secondary and sell in the secondary. The thing stays private for 15 years. What's the problem? Like if you see your investment thesis play out, like Clint said, in 10 years time, and you want to sell, just sell in the secondary market. I think there's going to be a buyer there, and you won't have to sell at like a massive discount or anything. So yeah, but from diligence perspective for a company like this, I would say you just want to make sure that they're on point with their customer growth, that their product roadmap, which in this case I think is really Unreal Engine, that it has legs, and that it's going to be able to have market share, and that you're just avoiding any kind of large, landmines like this Apple thing kind of gets out of control on them, right?
Yeah, I 100% agree. I mean, it's safe to say the Vision Pro is an amazing product. I don't know if you guys have had a chance to play with it yet. I think Apple and Epic are going to have to bury the hatchet for them to get into that store at some point. And if that does happen, that's where I see the secondary market pop. That makes a lot more sense, right? There's a news that Tim Cook and Tim Sweeney are back together again. They're friends again. And now Epic's got products, and Unreal Engine is running on the Apple Vision Pro. That's a massive win for both of those.
Yeah, but listen, the public markets have come back. Like the QQQ, right? NASDAQ has come ripping back last year. The private markets didn't have that. So part of me is also not quite surprised, that these primary deals are coming through at a much higher valuation than where the secondaries are at, right? Because I think as a whole, the secondary market hasn't come back like the rest of tech has come back in the public market. So like it's going to be interesting to me to see if this continues to happen with other companies, right? Where there's like a primary round, it's significantly higher than where the secondaries are trading at, right? That's going to be really interesting to see.
Absolutely. So let's shift gears because there's been a story that's flooding Twitter. Basically, Sam Altman, it's rumored that he's trying to raise $7 trillion to make up for the shortfall on AI chips and bolster the future of AI across a number of different mediums. That's a substantial amount of money, eye-popping in a lot of ways. It's actually the market cap of both like Microsoft and Apple combined, which are the two largest market cap companies in the world. So I want to hear your opinion, Nick, for as the guy who digs the numbers. When you see $7 trillion, like let's just go through how. Tell me what you're thinking when I say that.
Yeah, you said billion, right?
No, 7 trillion.
7 billion.
7 trillion.
7
With
trillion.
a T, yeah.
So how much?
That's what goes through your head.
Revenue,
he goes, that's not right.
So how much revenue did NVIDIA have last year, right? It's 28 billion. What's your revenue multiple on the stat?
19 billion in net income, which is absurd.
Or was that the annual equivalent? Yeah. But like what's the multiple on that sucker to get to
40 times sales.
And not even that's just the amount raised on a valuation that has to be substantially higher. It just doesn't. I don't know where that number comes from. It just isn't based in reality. Like, are we doing like 20-year projections on this? Because Aaron's going to sympathize.
So, no, Nick. So listen, I like dug into this because that's ridiculous. So I'm like, what exactly is that? So a lot of it's debt, right? Is what I read after I got into it.
Is it OpenAI debt though, or is it just like is it part of his new company?
Yeah, I'm getting the sense that it's a different company, right? The reason that he's doing it is he thinks that he's not going to be able to get his hands on chips. So if they do AGI, they're going to need more chips than are actually available. So like literally the total capacity of chip manufacturing needs to increase dramatically. So, and then also too, you're reading this through the press, right? But as I was researching this, it sounds like he's actually going to do this with the existing chip companies. So he's going to go to NVIDIA. So he's not raising the $7 trillion. It's all of the chip companies would raise in equity and debt. He would like OpenAI would commit to purchasing these chips, right? And of course, the $7 trillion comes in over time. So this, I just think he's telling people it's going to take $7 trillion of capital to build the chip manufacturing required.
Don't you feel like he's suggesting there's a problem that we don't really have yet, right? If this came out 2 years ago,
that's how I feel about it.
Come on, man.
Yeah.
And then it's kind of like throwing out a purchase order, right? Is what he's doing.
It's true.
And
it's true.
Saying, all right, let's fill this purchase order for the benefit of OpenAI. I mean, what is Jeff Bezos going to say if he's got the Anthropic state? What is like? these companies came out of nowhere so quick. And by quick, I mean in the last 3 to 7 years, right? The numbers just aren't making any sense. They're not going to add up.
I mean, I know, Aaron, you're an investor in OpenAI. And so, one of the things that's well known about OpenAI is that Sam, while he is a co-founder, he does not own any equity in the company. The company is valued at a massive amount of money. And as a result of that, a lot of people have questioned what his incentives are to grow OpenAI to this multi-$100 billion company. And now there's news over the last 6 months of him starting other companies that seem to be in parallel to OpenAI.
Smart.
But as an OpenAI shareholder, how do you feel about that? Do you feel like there's a little Eloning here where he's
no, do it.
It's fine.
It's America. Do it.
But don't you feel like as an investor in the company, though, and you're investing in Sam's ability to execute. Now, Sam's dividing his attention between OpenAI and other things. Like, you believe it all just comes out in the wash at the end.
Evan, throwing it back to you, don't you think that somehow Tesla benefits SpaceX and SpaceX benefits Tesla? And that all benefits Starlink and Twitter. And it's become the little Elon Musk fan club ecosystem, love him or hate him. Respect his ego or not.
I definitely do.
So
I definitely do. But the only difference is that Elon has massive stakes in all of those companies. So he's directly incentivized along with the cap table to make those companies large. Versus OpenAI, he does not have that incentive. And we've already seen shuffles at the company and issues with the leadership and the nonprofit to a profit, et cetera.
I mean,
I wonder if any of this is a result of that rather than the natural state.
At this point, the dude has his money, right? And he's not like a billionaire club or anything like that because he doesn't have all the other assets and things. But we're helping his ego and we're helping his fame, and some people drive off of that, right? And I think in some cases that's where you want to start. And you can use that fame to then do other things. Like if you're looking at, who's the WeWork founder? Adam Newman's going out. And he's like, I want to buy WeWork out of bankruptcy because I love it so much. Dude, thrives off fame and actually promotes and helps the businesses. I don't think it's that much different. Right. The parallel is a fair one in my opinion. Sorry.
So let's actually shift then toward away from OpenAI. As I imagine, Aaron and Clint, you're probably investing or at least looking at a number of different companies in the space. When you see the CEO of OpenAI trying to secure $7 trillion of GPUs, does that give you pause on potentially investing in competitors? Does that feel like there's a moat there?
I just think you have to, I think what this is going to create, I don't think we're really looking at where the congestion is going to be. The congestion is going to be in converting energy to these productive uses. And so I think that's what we're missing. I think the bigger issue is not the chips. It's literally the energy required. Like if you really start to go down the rabbit hole of $7 trillion in chips, and the amount of compute and energy usage that's going to require,
right?
You start to your bet starts to change from these AI companies to energy congestion. Me talking to one of my friends who trades electricity congestion in the Virgin Islands and to let me into his private little fund. Like this is absurd. So I think that's more where my favorite plays in AI. It's almost a barbell approach, right? It's not the open AIs. It's not my favorite. I think you want to bet on the picks and shovels plays of this business. I think the data is a big thing, right? Because I think data is extremely valuable and that value is undiscovered. And then I think this whole energy thing, right? That's what was alarming to me is seeing $7 trillion and then starting to think about what that really means. It's a lot more than just chips. And I think that's where the real opportunity sits. So that's where I would be looking to play more than just these other AI companies.
Yeah, it's all about the next 10 years, I think, in venture is going to be all about AI. And I think just like how AWS and Google Cloud and Microsoft Azure hit the scene and now, tech companies can benefit off of that. There's going to be new companies, new infrastructure, new picks and shovels plays, like Clint just said, that will support this AI, industry that will evolve here over the next 10 to 15 years. So there's going to be a lot of money to be made in those businesses. There's no doubt about that. So, but I do think that's the play. Maybe the other side of the barbell, right, to Clint's analogy, is you have kind of the picks and shovels play on one side. And then I'm in the camp that someone's going to solve for AGI. And my bet is that that's going to be OpenAI. So that's why I think it's interesting. So if you have a Google out there, Microsoft, these are $1 trillion plus market cap companies. and Google does paid search. These guys created a human brain inside of a computer, right? Human level intelligence with a computer. That's got to be at least $1 trillion business. So, right now, I think if you believe that OpenAI can do that at $100 billion entry point, then that probably makes sense. If you think they're just going to be like a large language model business, I don't know if that's super interesting at this point, right? I'd probably just stick to the prick and shovels plays, right? Because I think that's a sure thing.
To that end, I almost feel like
AI is not going anywhere.
Yeah, I think you guys are both describing a wartime economy. We're all working towards something. We're trying to get there faster than anybody else. And a lot of those things that we're all talking about, whether it's like compute or store or energy to do it, that's infra.
Yeah, and I really like the approach of taking the super picks and shovels, broad view approach of energy. I mean, that's probably a play, like invest in uranium, lithium, basically all the plays around energy. So you capture basically the upside of the entire market.
Yeah.
Versus, a more concentrated bet on OpenAI. I think that's interesting. When I look at the story, I look at the number, Sam has been really impressive in his ability to raise capital across all of his businesses throughout his career. So, OpenAI is not an open ecosystem. They are a for-profit. They're clearly focused on trying to build a massive Magnificent Seven style company. Right. And so if he's trying to get into bed with NVIDIA or Taiwan Semiconductor or any of these other GPU manufacturers and put together a consortium, it gives me a little bit of pause to be like, well, what about Sam's enemies, which we already know Elon's trying to compete with him. Obviously, there's open source. Zuck has got a couple $100 billion in his own pocket that he could probably play with. So I think it's quite interesting to see the sheer size of the dollars going into the ecosystem itself.
I mean, I would just say if you don't have AI exposure as an investor, you should be thinking about getting some exposure. And I mean, like there's, of course you can be in Apple, Microsoft, Google, et cetera. Those are obvious ones. Everyone's got S&P 500 exposure, at least most folks do. But, I think some of the pure play opportunities are really interesting. And that's where you got to go into the private markets, I think, to really capitalize on those pure play opportunities.
That's actually like a perfect transition to our next topic. There was a little bit of research that came out of Altimeter Capital talking about the AI venture investing and how a substantial amount. So I think they said it was like $35 billion of venture funding went into AI companies in 2023. And I think a staggering amount, over 20 billion of that was actually corporate venture on behalf of Amazon, Google, Microsoft, NVIDIA. And the research was sort of pointing to a lot of these deals that were structured not as just pure equity investments, but they were structured in a way that in exchange for cash and future cloud compute, these large companies would acquire equity stakes in these up and emerging AI companies. And the research was sort of pointing to, that's been very beneficial to the tailwinds of those stocks because these companies look like they're getting nice large equity portions in the future. At the same time, they're also quasi juicing their revenue because you're looking at, Azure, for example, has this deal with OpenAI. I think they invested 10 billion. Half of that was going into equity. Half of that was going into Azure credits. Now, Azure usage is growing substantially. In fact, they're really making headway against AWS. And so the report was saying that, the reason why these Mag7 companies are sort of flying high because they've now basically locked in their customer base. They've juiced their own revenues by offering these free cloud compute in exchange for equity. And now they've locked in their future partners. So first, I'll kick it to you, Clint. It seems like you're more macro on this stuff. When you hear that and you look at this research, what do you think about and how does that make you look at the broader ecosystem?
Yeah, I mean, look, I think it's not black and white, right? It's kind of in the middle here. I think it's smart that they're making these investments from a platform play, right? Because they own the data, or in NVIDIA's sense, they have the chips. But it also reminds me of that Financial Times article we just saw about NVIDIA, where it said the title of it was "Sell NVIDIA," and it was talking about their investments, right? The companies they invested in through their venture arm being a rising percentage of the demand for their chips. And so it was kind of pointing to that self-dealing mechanism. And I think that's what you're getting with this. So it's not as easy to do the analysis when you have that happening. And that gives you a little bit of pause as an investor because it doesn't look clean, but I don't necessarily think it's a bad thing, right? I just think we have to say, okay, we're in a new era here. They understand that they're going to spread their bets. They're going to invest a lot of these different businesses. Number one, because they can be customers. And that's a conflict, but it's not like a bad thing. There's investing people are going to be customers, right? It's kind of securing the infrastructure. And it's also saying, hey, just like any venture play, 1 out of these 10 is going to be a home run. And I'm making that bet because we're in uncharted territory. This is the Wild West. So I think, yeah, from a traditional sense, it looks kind of weird and ugly and gimmicky from an accounting perspective. But when you really dig deep, I think it's just we're in uncharted territory. And I think there's going to be a lot of winners and a lot of losers. And I think there's huge opportunity for 100x plus gains. And I think they're trying to capitalize on it.
Hey, Nick. And so, with this sort of like cyclical self-dealing in some of these deals, does it make it more challenging to figure out price discovery and accurately value these companies? Or how do you build that into the way that you're looking at the market from a numbers perspective?
Yeah. So Clint has a great podcast. Here's the promo, Fat Pitch. And I remember they had me on and they asked me, where would you invest? And my idea there on the spot was really about long duration. And you know what? In the short term, it's going to be real hard, Evan, to price this stuff. You're going to have to figure it out. You're going to have to feel it out. I don't love the term self-dealing. I think it's my term that I threw out there before, which is a long-term purchase order. You're kind of figuring out you've got this big, long purchase order with a long duration. Hopefully, a couple of these will shake out and do really, really well, and a bunch will go by the wayside. But then you'll be locked in, and that you try to unwind an account with somebody and see how that goes. To get in early with some really impressive companies with great founders, great backing, that will pay off. And then, you know what? It's going to be a hell of a lot easier to price in 5 years and 10 years once they have those revenues that are more mature. Like Epic Games, I know this is a funny one, but actually if it does go to IPO, that's not going to be the most difficult thing in the world to value. It's a company founded in 1991. It's been around for a long time. They have established revenues, a certain growth rate that's kind of coming and going. That's I think the focus here. I don't need to value a Series B company. I need to make sure I can value it when they're really kicking off revenue. Maybe they're profitable. Who knows in this space? But that sort of idea.
And so, Aaron, you were the one a few minutes ago. You just said, like, look, if you don't have exposure to AI, you should get it. Now is the time. And obviously, we've here on the podcast talked about the private exposure. But I guess, elaborating here on what Clint and Nick just said, it sounds like you could quasi get exposure to some of these companies by just investing in the public ones, with these magnets. And so if you're evaluating placing a bet in the private markets on one of these companies versus the public, like how do you determine where you should put your money and what the upside and downside risks are in that?
Yeah, so I think, like Clint mentioned, picks and shovels are interesting. So Databricks, Hugging Face are two like names that jump out at me and that I would categorize as like a pick and shovels play. And I also think too, if you want to kind of be more on the customer facing side with these large language models, I would stick to firms that have relationships with the big cloud providers. So that would be OpenAI with Microsoft, Anthropic as Google, and Amazon coheres with Oracle. Right. So, I mean, it seems like folks have kind of placed their bets a little bit. Now, those cloud providers have relationships with other, Databricks and Hugging Face and other, AI related companies too. But there's kind of like these strategic partnerships, if you will, from a distribution perspective. So, OpenAI sells a lot of business through Microsoft, and I'm sure Anthropic's selling a lot of business through Amazon and Google. So that's pretty special. That's a pretty special mix up. So I think those are probably where I would stick. And I think you've already started to see some firms that don't have those types of relationships, especially in the kind of the large language model space up front, that have kind of started to fall by the wayside a little bit. So I think you'll probably have a handful of winners in that large language model space, those names that we just mentioned. And then I think you'll have a lot of picks and shovels opportunities, right, to come in and take advantage of.
And just to piggyback off Aaron here, this isn't like buying Berkshire Hathaway and half your exposure is going to be to Apple, right? These are not making up substantial sums for a lot of those smaller companies that, let's say, would be in the NVIDIA Ventures portfolio. So I don't think you're getting proper diversification just by doing that, going into the public market and saying, oh, yeah, we're good. It's not going to be there. Yeah. And then nor will the liquidity as well, because we alluded to the secondary market being kind of more liquid than anyone anticipates. Let's say if you wanted to buy Epic Games, we're seeing hundreds of millions of activity there. It's probably prudent to start thinking of a small portion of your portfolio would be allocated directly into the privates.
So if you go back to 2008 when the iPhone came out, the top 25 in the S&P 500 looked a lot different than it does today, right? 15 years later with the iPhone out and the App Store out. And I think 15 years from now, you're going to have a much different group of companies in the S&P 500, the top ranks of the S&P 500, a lot of which maybe have just started recently or are about to start, right? So I think AI is going to have a major impact in kind of the public stock market. And a lot of these pure play companies, I think, will pull through and go public eventually and be in the top echelons of the S&P 500, right? So, you know, it's kind of a nod to American ingenuity, right? That it doesn't matter that these companies are huge and they have like literally tens of billions of dollars of cash. Brand new companies can start and grow to $1 trillion plus valuations, right? And take market share from incumbents. It's really, really fascinating, right?
To play the devil's advocate to that just for a second, though, because I feel like we're in a very special time period where we've got companies that are so powerful and so intertwined in technology, which these Mag7 companies are. And in a lot of ways, you know, these AI companies, which are building really, really incredible technology, they are sort of hitching their wagons to the success of their parent companies in some way, right? And so do you feel like that could be inhibiting to their success in any way, where, you know, at the end of the day, whatever Satya sort of says, let's say you're a startup, you somehow lock a deal with Microsoft, like you've kind of locked yourself in there. You don't have the optionality. You don't have the flexibility that, say, like a Google had in the past when they bought, you know, YouTube, or when, you know, Facebook buys WhatsApp or Instagram. It's like they're a little bit, there's like sort of a kingmaker above them that they have to manage toward. Does that give you any pause as you like evaluate these smaller but yet super large, interesting opportunities in the AI space?
Yeah, look, if I'm a CEO of an AI company right now, I'm probably in a tough spot. Like, I need access to chips if I'm going to grow properly and deliver a high quality product. So I have two options. I could either go and build one of these server farms myself, which costs too much money. So I'll totally dilute myself and it won't be really interesting for me to do this anymore. Or I can go and strike a deal with one of these big cloud providers and use their chips. And to the extent that I can not have to pay, I can pay with equity instead of cash. That could be much more compelling because now I can spend that cash in other places, right, to drive and take market share from competitors or to build better product, right? So, you know, that I think is probably a lot of what's going on. It's not cheap to get these things off the ground, and I think there's just some hard decisions that these CEOs have to make, and it's just like a reality of running these AI businesses. Now, to Clint's point earlier, picks and shovels plays come out, and this stuff starts to get, there's like a future AWS type thing for AI. And now all of a sudden you don't need to like strike some special deal with Amazon or Microsoft to be able to run your business properly. Four guys sitting on a podcast can go whip up an AI business and we're in market and it's on the cheap, right? And those days will probably come, but they're not here yet. So this is kind of what I think these folks have to deal with. I'm sure they're not happy with giving away so much equity.
No, but
you know, to
maybe
these
business,
firms,
though.
But it is what it is.
I mean, doesn't matter what you're in. I mean, I just moved bank accounts today, right? Adding another bank to the portfolio, good problem to have, right? But if I'm starting an AI company relatively small, I'm going to have 3 or 4 providers compete for my business, and I don't necessarily have to get exclusivity with Amazon or Azure or Google, right? And maybe they'll ask for it, but you could probably pump through credits on a few sides, take 2, see which one performs better. But as Aaron described, I mean, if everybody's going to be hungry for compute, I mean, just go with multiple providers at all times. Like, get as much as you possibly can. You could load balance as well for when it's going to be cheaper or where it's going to be cheaper.
At the end of the day, I think this is going to evolve so fast. I think right now this is the model because it makes the most sense. But when you start to think about regulation and antitrust law and how that's going to shift in the face of AI, especially as it starts to really replace white collar jobs.
Yeah, true.
And quickly.
Yep.
I think this is going to evolve so fast. We have no idea what it's going to look like 5 years from now. So this is the model today. I would bet rather that this won't be the model going forward in 5 years, especially when every financial advisor, accountant, and lawyer has been replaced by artificial general intelligence or what have you. you're going to have a whole different world in front of you. And so I think that's kind of the viewpoint we have to have here. I'm not bothered by this model at this point. I think it's what you have to do, but I don't think it's going to be the lasting model. I think to your point earlier, Evan, about hitching your wagon to this, when you start to think about some of these companies and what their multiples they're trading at, right? We've got to also remember that passive indexing and flow-based data and a lot of the variables that affect stock prices aren't always going to be there in support of prices just doing nothing but going up. And so you're also going to have times, and I'm not, I don't believe in this whole bull versus bear notion, but you're also going to have times when these stocks go down in value.
Right.
And that's also going to impair their ability to deploy assets. And it's also going to impair the companies that are hitched to them. So I don't think it's just a one-way street here. And I think it's going to evolve.
Yeah. I mean, Clint's right. This is going to change a lot over the next 5 years. So I'm of the opinion all investors should have some exposure to AI. And I think pure play AI is really smart. But you got to stay on top of it. And I don't know if I would like fully deploy capital right now, because to Clint's point, I think there's probably going to be new companies that come out. This is going to look different with regulation, and there'll be maybe different winners and losers. So, get some exposure now, but I think about getting more exposure next year and more exposure the year after that, and kind of building your way into a proper position in your portfolio, I think would be a wise thing to do over time.
Clint, do you think we're closer to 1999 or 2003? If you were to compare,
when you look at valuations and you look at ARM today, right? I mean, you see some glimpses of 1999, but you also got to remember, like, I don't think this is the same thing. I never think history repeats, it rhymes, but I do think at the end of the day, 40 times sales for NVIDIA is unbelievable. The fact that NVIDIA is from a market cap perspective larger than the entire Chinese stock market, that it's larger than the entire energy sector of the S&P 500 that produces 10x its net income. That doesn't make fundamental sense. But that doesn't mean I want to sell NVIDIA. I'm just making a point that there's not a lot of rationality right here. And so I can see some glimpses of 1999 there. But going back to the portfolio point, I think a great portfolio here is position size well into AI. You have to have exposure, to Aaron's point. Think about when I say picks and shovels, I'm meaning energy, things like that that are going to be required for that investment to be successful. And then I start to think, what's AI going to replace? And it's going to replace a lot of white collar jobs. So I want to go in private equity and I want to buy HVACs and plumbers and roofers and stuff that's needed, that people are going to need, that AI is not going to replace, no matter what Elon Musk shows me in a video of a humanoid robot or Boston Scientific, them doing flips. I don't care. At the end of the day, somebody's going to walk in my house and fix my plumbing in the next 5 years. And so I kind of think of a portfolio approach almost in equal weights, right? Just being dumb from a 1 over N approach and just saying, hey, I want those 3 buckets. And I think that makes a lot of sense from a portfolio, but I absolutely agree with Aaron. You have to have exposure here.
All right. Okay, so we're running up on time here. I got one last 2 topics, but I'm going to jump to one because we spent a lot of time talking about AI. We've talked about venture. There's another, what I would say, groundbreaking technology that sort of came to market in the last couple of weeks, which is this Apple Vision Pro, which, they announced it last summer. And when it was announced, it was quasi-panned. People were like, this is kind of ugly. I don't know how people are going to use it. The battery pack is attached to it. It doesn't really have a lot of function. But in the first 2 weeks of, since it's gone on sale, I think they've sold over 200,000 units. And I spent years as a hardware venture investor, so I understand it's a totally different type of business to underwrite. But to Clint's point, what he was just talking about, the physical businesses in the world that require human labor and probably will not be totally AI removed can still benefit from an innovation like this. Like, I can imagine some guy doing an HVAC installation and having augmented reality vision and deciding which type of gas to pull or which lever to cut to make sure it's safe, et cetera. And so I think there's a lot of opportunity here. And again, 200,000 units for a device that's $3,500. This is not a consumer price point, and it's still a pretty impressive launch. Nick, I'm going to kick it to you. So what do you like? Let's talk about this other investment theme of augmented reality and virtual reality. And, this has been a decade in the making. Well, remember, so $4.5 billion has gone into Magic Leap. Oculus was acquired for multiple billions of dollars in 2014 by
Right.
Meta, and they've launched multiple versions of the Meta Oculus Rift and then the Meta Quest. Where do we stand today, Nick, in terms of the market opportunity ahead and how these things are priced out and where investors should consider looking at finding price discovery for an innovation that's probably still 5 years ahead?
Yeah. So same as Clint was saying about NVIDIA, you're not going to sell it, right? You're not going to bet against Apple. That's a bad bet. I think we actually ran the numbers on this, I don't know, 6 months ago. And what I was doing with it, I said, all right, how much is the iPhone? How much is that going to actually cost? What percentage of iPhone users, let's say 1 in 1,000, actually buy this thing because that's your target audience? And the numbers kind of, I thought, made okay sense. You know, I do kind of want to poo-poo it because I'm seeing all the memes and it's hilarious, right? It's just everybody walking around town with ski goggles and like a Walkman, right?
But remember who that crowd is. That's a specific, very niche early adopter
They all
crowd.
drive Cybertrucks, apparently. But kind of one of those things, how much would you pay for your iPhone? So whatever the new iPhone 15 is, if it's 1,000 or 1,200, if somebody took that away from you, you guys would be annihilated, right? I don't think the Apple Vision Pro has that same sticking power, right? Because the price will have to come down. But at the same time, those early adopters don't care about price point. They're going to buy it and they're going to play around with it. I think this augmented reality stuff is actually really cool. I like to laugh at it at the same time, but there's something here fundamentally that is going to be game changing because it's so much better apparently than the Oculus that I have and never really use. It just collects dust in the closet.
And Clint, so we already heard that you're bullish on the metaverse. What's your take?
Yeah. I mean, I love it. I think to your point earlier, I saw someone do an auto mechanic work with it as a demo, and that's pretty phenomenal, right? When you start to think about the ability to fix things and do your job, and it really does elevate your skill set. No more reading an owner's manual when I'm assembling my exercise equipment, right? I get to literally put on this thing, which I don't have it. Aaron was with me when I almost bought it one time and I had buyer's remorse. But like literally you put this thing on and you're able to assemble anything right then and there, and it tells you exactly what to do. I think it's profound. And I think Apple's that was always my bet. I think wearables are going to be a big piece of this, AI / metaverse, just / tech innovation. I think wearables are going to be a big deal. And I think Apple was always the best play there, especially when you think about like Ready Player One.
Yeah.
I could easily see Apple like instead of I put my Apple Vision Pro on, I've programmed in all my measurements and I can literally walk into any store, right? Have something custom made for me and then at my door by the time I get home, right? Literally in the metaverse. I love that whole notion. And I think this was a key ingredient to make the metaverse a reality. And I think, again, it's just hopefully your point back to Epic Games. I hope it just makes Tim and Tim become friends again because we need Tim squared for this to be a long-term reality. But
Sure.
But yeah, I'm super bullish on this. I think the price comes down over time. I think Apple's going to be it's the natural hardware player because of their established ecosystem.
Yeah, that's it. That's the App Store, man. Like, so to Nick's point, the iPhone's great, but if it had no apps, I mean, who cares?
It didn't even launch with the App Store. It wasn't even until the second generation came out that the App Store was even part of the software stack.
And I think that's when people got interested in it, right? So like now to like Nick's point, if you had the iPhone without the App Store and you took it away from me, I'd be like, I'll go get a flip phone. Like, what's the difference? Now you have the App Store, and if like you got another phone and it doesn't have the same apps, that's like a problem. So, in the same way, I think if the Apple Vision Pro, if that's where developers go and they start to develop apps, and to Clint's point, there's like an auto mechanics app and a plumber's app and that, whatever. There's technology solutions being developed for that platform and that app store. That's when you're going to see like people can't live without this Apple Vision Pro. I'm like less bullish on the Apple Vision Pro for entertainment purposes. I think there could be some cool applications once they get really dialed in with like FaceTime, where it's not a little box. It's like the person's actually in the room with you, which I'm sure that's coming with some AI. I think the big application where they'll sell a ton of units is around business. It's like no one on the planet would ever think about doing their job without a laptop.
Is there a play for investors? for investors who want to get exposure to this innovation, if you're trying to do the same strategy or thematic strategy in the private markets for VR, AR, are there any plays?
Epic Games.
Are you seeing anything
Yes.
happen?
So,
Epic Games.
Unreal
I
Engine,
want to
yeah.
go back to that first topic. It comes full circle with the Epic Games, right? Because if they have that Disney exposure, and then if you're looking at what's going to occur between a Disney and then you've got the Apple component here, and then Epic Games, you're going to want to have a complement or competitor to the Unreal Engine. So I know Aaron touted this. The Unreal Engine has to go in the comments of this podcast. If no one has watched the introduction to what content could be created from 14-year-olds, it's absolutely incredible, or unreal, right on the label. So I feel as though there's going to be so much entertainment bang for your buck out of folks being able to create those content or immersive experiences that I can design an area to hang out with my buddies and invite them over in the metaverse. And it's what I've designed, because you can spool up absolutely dynamic environments through the Unreal Engine that you're going to want to show off and you're going to want to put out there, and you're going to want to buy that metaverse real estate, which is massive. I cycle down Fifth Avenue pretty much every morning, and I see the Louis Vuitton store, and it's really cool looking, or Prada or Gucci or whatever. But they're going to have the most incredible metaverse stores that put the real life to shame, right? You're going to have movement, you're going to have structure, you're going to have music, you're going to have everything that's tuned to you and where you are in that store and that environment. And to Clint's point, they're going to know your measurements, and the second you walk in, they're going to know what looks cool, looks good. You look down, and, oh, there it is. It's on you. This is going to be outrageous 5 years from now, and I'm pretty excited to see how it shakes out.
I think Clint, Aaron, and I are excited to see you bike down Fifth Avenue with a headset on.
It's a very.
This has been an awesome episode, guys. But another great episode for This Week in Pre-IPO Startups. I'm Evan. I got Clint, Aaron, Nick. Thanks, guys, so much for another great episode. Looking forward to next week, and we'll see you guys later.
Okay. Thanks, man. See you.
Thanks, guys.